This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Erik Townsend and Patrick Ceresna.
MacroVoices episode 395 was produced on September 28, 2023. I'm Erik Townsend. Bloomberg's Simon White returns as this week's feature interview guest. We'll discuss the soft landing versus recession narratives, secular inflation, credit market risks, and much more. And I also have a big announcement to share with the MacroVoices community right after my interview with Simon and before Patrick's postgame chart deck.
And I'm Patrick Ceresna with the Macro Scoreboard week over week as of the close of Wednesday, September 27, 2023. The S&P 500 December futures were down 301 basis points, closing at 43.13. Decisive selling continues in the post-FOMC period. We will take a closer look at that chart and the key technical levels to watch in the post-game segment. The US dollar index up 115 basis points, closing to 106.65, a breakout to new 2023 highs. The November WTI crude oil contract up 448 basis points to 93.68. That's a breakout as well to new 2023 highs. We'll take a look at that chart, and Erik will have the EIA inventory data in that post-game. The December gold contract down 386 basis points to 1891. It's a breakdown now all of all the previous summer lows. Copper down 345 basis points to 364, and also now trading back down to its 2023 lows. Uranium up 605 basis points to $71. Uranium continues to bull to new multi-year highs. 10-year Treasury yield up 20 basis points, closing at 461 points. A material breakout in yields pushing many bonds below their 2022 lows as relentless selling continues. The key news to watch this week is the U.S. Core PCE Price Index and consumer sentiment. And next week we have the ISM Manufacturing and Services PMIs and the much anticipated jobs numbers. This week's feature interview guest is Bloomberg's macro strategist, Simon White. Erik, why did we invite Simon back as a guest this week?
Well, Patrick, Simon is a solid macro guy. He's a co-founder of Variant Perception. He's been featured on this program before, very well respected. And I think it's perfect timing to get him back on because something I want to do, not just with Simon, although we'll start with him this week, but with other guests who have strong views on secular inflation, in both directions. I want to get them to comment on something that's really been perplexing me, which is, I'm very much a secular inflationist, but I listen to really smart people like Alex Garevich talking about an extreme opposite event. And I think, okay, I ought to at least hedge against that outcome that, potentially could be going against almost all of my trades. I don't know how to hedge against that kind of situation. I think you've got to get this secular inflation call right in order to do anything other than very long-term buy and hold investing. And I don't think this is the right decade to do that in either. So but the question I'm really starting to think about for my own investing is, what do I do to just hedge the scenario where I might have this inflation call completely backwards? And I'll certainly begin by asking Simon to weigh in on that in this week's interview.
Well, Erik's interview with Simon White is coming up as Macro Voices continues right here at macrovoices.com.
And now with this week's special guest, here's your host, Erik Townsend.
Joining me now is Simon White. Many of you remember Simon when he was a co-founder of Variant Perception. That's the leading indicator guys that we like to get on the show every 3 months or so. Simon has moved on now and is Bloomberg's Markets Live macro strategist. Simon, it's great to get you back on the show. Listeners, Simon has prepared a slide deck. You'll find the download link in your Research Roundup email. If you don't have a Research Roundup email, it means you haven't registered yet at macrovoices.com. Just go to macrovoices.com, click the red button above Simon's picture that says looking for the downloads. Simon, I want to start with what's on everybody's mind. The long-awaited recession, is it really going to be forgotten in favor of a soft landing, or is the recession still on the horizon?
Thanks, Erik, for having me. And that's a great question to begin with. So I would say I think the consensus certainly seems to have shifted much more towards soft landing, no landing scenarios. I mean, stepping back, there's an issue here with none of these things are very clearly defined. So I think everybody's in a position where they can be right or at least not proven wrong. Although I think a hard landing is, fairly clear, like if we get a recession. But even then, a recession is not something that's clearly defined either. I tend to go by the MBER, like they're the kind of the arbiter of whether there's a recession or not, and they give some guidelines about what they call a recession or not. But even there, there's a lot of kind of fuzziness around the definition. So I tend to look at recessions, economies kind of switch into recession. So they are a regime shift. And I think that's what really kind of catches people off their guard is not only are recessions, they're pronounced, they're protracted, and they're pervasive. The three Ps. I'd say there's a fourth P as well. And they are precipitate, and they tend to happen very abruptly. So that's what I've tried to show in the chart on slide 2, the right-hand chart. And they tend to happen when you get interactions between hard and soft data. So soft data is your market data and survey data, things like ISM and consumer confidence. And hard data, things like industrial production, retail sales, etc. And when these two tend to operate off each other and they generate a feedback loop, and past a certain threshold, they hit a cascading point, and that tends to be when you get recessions. And what's kind of interesting about the chart is you'll see that there's a number of times when you have a stress in the soft data, but you don't get a stress in the hard data, and you don't get a recession. And they're really the times, the Fed is kind of, this is what the Fed's all about, right? The fabled Fed put is essentially if they can stop soft data stress bleeding into the real economy and then creating one of these feedback loops, then they're kind of like, they've done a reasonably good job. They prevented a recession. And where we are today, again, if you look at the chart, is you can see that both hard data and soft data are stressed, and they're past a threshold that has normally been associated with recession. So I think we're at a very kind of like hot point. The soft landing narrative, I think, is as I say, I think is basically misguided. I think that often just before a recession happens, people tend to be off their guard, and rapidly you get a decline in the data. And that's exacerbated by the fact that most economic data, some of it considerably so, is revised. And here's the kicker. It's often revised at most at turning points like recession. So going into recession, you're kind of most blind and the data is most wrong. So, we've got a number of things that are standing out to me right now that I think are consistent with prior recessions. So the claims data. Now, you can look at that in two ways. You can look at the national data, which is what most people focus on, but you get a lot more information content if you look at the claims data by US state. I mentioned, recessions, one of the attributes they have is they're pervasive. So you tend to see things worsening across sector and geography at the same time. And the claims data by state picks that up. And what we've seen over the last few months is that you're seeing deterioration in claims data across quite a high number of states to a percentage of states that's been consistent with a recession in prior years with a very high kind of hit ratio. And that's the unemployment claims and continuing claims as well. So I think the recession is much more likely than the consensus believes. And I think when it does happen, it will happen much more abruptly. The data will suddenly take a massive turn for the worse. And also subsequently, the data will be revised a lot lower. And we won't know, we never do. We never know we're in a recession ex ante. It's only ex post. And that's really where it gets interesting, because obviously telling someone that a recession has already happened is useless as an investor. And what obviously as an investor you want is some sort of leading idea that you're going into recession, because equities, they're kind of like not super quick in terms of like they don't sell off a long time before a recession is deemed to have started, but they do sell off a little bit before, and they sell off obviously through the recession. You get a good drawdown then, and they start rallying before the recession ends. So if you look at the way equities are behaving right now in the median sort of around recessions, or sort of median after bear market. So, the bear market that we've not quite left, depending on how you define it, but we've certainly not made a new high back in January 2022. right now markets are behaving in a way that's consistent that this is a bear market that's not going to be followed by a recession. So it's clearly not yet priced. And complicating the issue as well, and something maybe we'll get into later on, is I don't think this will be a normal recession. Certainly not the garden variety recession that most investors will be used to, because I think this recession is going to be accompanied by elevated inflation. And that really kind of complicates matters and changes what people are perhaps expecting going into a recession.
Simon, we recorded this segment mid-session on Tuesday when the S&P was trading around 4,330 on the December futures contract. Tell me about how you see this market. Is the sell-off that we've seen for the last couple of weeks, I guess I think of this as a lot of us saw the recession coming, or we're telling ourselves we saw it coming, but then we saw this bear market rally continue well beyond the 61.8% fib retracement, all the way up to 46 something before it seems to have topped. Was that a top? Are we seeing the beginning of the market discounting this recession? Is it time to short this market? How should we interpret this weakness? We've been under all the short-term moving averages for more than a week now.
So this has been something that's keeping me awake for the last few weeks, because there's a huge amount of going on right here. We have the recession risk, which has been ongoing. And as I say, it's not clear until after the fact that you are actually going into recession. As I say, there's a number of things that I look at that are consistent with a recession beginning in the very near future. So there's potentially something like that has been sniffed out by the market. But we haven't really had, we had the JOLTS numbers that surprised the downside a few weeks ago. We've had the fact has been noted that payrolls has consistently been revised down this year. But we've not had anything, really recently that would suggest that all of a sudden that, the market is getting sort of recession vibes. So I'm not 100% sure it's generally a growth story right now. We've got yields rising quite precipitously high and quite fast. And again, that's something we can get into in a bit more detail. And if you look at breadth, I think some of the breadth indicators are showing signs of deterioration. They're not like red alert alarm bells level, but they are giving signs that you kind of want to be tactically negative right here. But complicating this issue is on a sort of more medium-term basis, and I looked at this back in March and April, is liquidity is still very supportive for risk assets. And that was something that was kind of interesting earlier in the year, because people were fairly negative back in, say, March sort of time. Sentiment was certainly less good than it was, say a month ago. But excess liquidity, which I think is one of the better measures of liquidity to look at, and I define that as a difference between real money growth and economic growth, started to turn up. Not only does it have an empirically leading relationship with risk assets, in fact, we have a graph of it on slide 3 with the price of oil. It tends to be quite a inherently contrarian indicator, because growth is slowing down, but then money growth picks up in response to growth slowing down. Inflation is a lagging indicator, so it comes down, and you get excess liquidity rising. And that excess liquidity, money growth is created by banks and it's created by central banks. And what isn't used up by the needs of the real economy is essentially excess, and tends to find its way into risk assets. So I think that was a real key thing that indicator, that liquidity started to turn up back in March. And I think that's one of the reasons why, markets like oil and stocks had been rallying, for most of the past 3 to 6 months. So on a medium-term basis, that hasn't turned back down. Excess liquidity is still rising and it hasn't turned back down. I have some reasons to believe maybe in the next 3 months or so, it may start to turn back down, but it isn't turning back down now. So you kind of got to be strategically still on a medium-term positive on equities, but on a longer-term, even longer-term basis, structurally, I think that's very interesting, because I think there's a number of things that people have not really priced in yet. We'll touch upon inflation in a second, but I really think that's a huge game changer for a whole number of things, not least probably one of the most important ratios in finance, which is the stock-bond ratio. And I think that's really going to sort of play havoc with asset allocation over the next few years.
Well, you read my mind when you said inflation comes next. I definitely want to talk about this because, boy, I think that we clearly agree that a secular inflation is likely to return. Something I've learned, though, is I think that, but a lot of the people who also think that think it for completely different reasons. So I'd like to focus on why specifically you think there's going to be a return of inflation. Is that a secular inflation? Is it going to be with us many years? And what are the drivers?
So I think you have to stand back, quite a long way at first. In terms of over the last few years, I think a lot of people have not maybe fully understood really why we're getting inflation in the first place. I mean, the classic excuses, if you like, are the pandemic and Ukraine. But I really think they're more approximate reasons rather than the remote reasons. I think the remote reason behind pretty much every inflation, historical inflation that we've seen, is the central bank monetization of large fiscal deficits. And that was something that was already in place, even before the pandemic. So governments, essentially central banks, had kind of run out of road. So traditional monetary policy had really been losing traction. There was a flirtation with MMT-like policies. And, you don't get inflation if central banks create money, but no one's really there to spend it. You can't make the private sector spend it. You can lead a horse to water, but you can't make it drink. All we had was asset inflation. We never really got any consumer inflation. But in the lead up to 2020, 2018, 2019, you start to see this rise in, fiscal spending, and you still had these massive central bank balance sheets. And that really, when you had the supply and demand problems that came out of the pandemic, and then they were exacerbated by Ukraine, they were to some extent, bad luck. I mean, I think they would have always created some sort of inflation, but I don't think they would have had the same traction as they otherwise would have. And the analogy, again, is the late 60s, early 70s. Now, again, everybody blames inflation of the 70s on, Nixon closing the gold window, the Arab oil embargo in the 70s. The end of the 70s, you had the Iranian revolution. But really, before that, in the late 60s, you had rising fiscal deficits and more easier central bank policy. In fact, the Fed overestimated the productive capacity of the economy. And that's one of the reasons why it eased too much. So again, it's separating the remote from the proximate reasons. And as I say, I'm of the view the proximate reason, the remote reason is large fiscal deficits that are being monetized. So that's where we are today. So we've now got much larger fiscal deficits even after the pandemic, and we still have very bloated central bank balance sheets. So that's the real underlying cause of inflation. The next question is, what has the Fed been able to do about it? Now, you would think after over 500 basis points of hikes over the last year or so, and inflation down from, say, a high of just over 9 down to 3 handle somewhere, you'd like to think that the Fed has had a lot to do with that. But really, if you look into it, I don't think that's the case. And you can look at an indicator that the San Francisco Fed creates. It's the core acyclical and cyclical PCE. So they essentially separate out the PCE, the core PCE, into the cyclical components. And these are the ones that correlate very highly with Fed policy. And the acyclical is everything left over. And what's really interesting, if you look at the acyclical, that's the one that's driven pretty much all the drive down in core PCE. The cyclical side hasn't really budged. So the Fed has really had no direct impact on inflation. And another way to see that, how does the Fed normally get inflation down? It does so through the vector of the labor market. And there's still hardly any slack in the labor market. You look, obviously, the unemployment rate, you look at productivity, that's really not budged. So the Fed has probably thus far had very little direct impact on bringing inflation down. What has driven it, and I think this is in some sense the elephant in the room, is China. China came out of the pandemic as the only country to have had actual consumer deflation, and they're still struggling to regenerate and kickstart growth. If you look at that acyclical core component, it correlates very highly with China PPI. And in fact, you can see on slide 4 a direct relationship with US CPI and China PPI. And China PPI, okay, it's been in the doldrums. China is having a real struggle bringing its economy back to revive its economy. But it's beginning to have, very small kind of traction. So you're beginning to see PPIs beginning to pick up. And, they don't have the tolerance really to allow their economy to remain in the doldrums for so long. So you are going to see inflation return in China. That inflation is going to feed into global inflation. at the same time as well, the Fed has not really had any direct impact. So even if the Fed policy starts to have some impact, it's going to meet this re-rise in inflation. So that's really the structural reason, if you like, why I think you're going to see this sort of second rise in inflation. But to be clear, I don't necessarily think we're going to see a new peak in CPI, but I think we'll see another rise. And that's not priced in by the market right now. If you look at CPI fixing swaps, they're really not anticipating any particular re-acceleration in CPI. So I think, again, that would catch a lot of the market unawares.
Thank you. That was an excellent, as you said, high-level perspective. Let's zoom in now to the much more timely this week kind of data. We've got a couple of things going on. A breakout, I don't want to call it a breakout, a move above 105 on the dollar index. 105 has been an important technical level in this market, so I see that as significant. But I think you also mentioned gold at some point in there. We see gold on Tuesday this week, as we're speaking, breaking down pretty decisively below its 200-day moving average on the continuation chart. Hasn't quite gotten down to the point of the lows we had back in June and July, but it's pretty darn close. Looks like it might be headed there. What are these things telling you, and how do they play into this inflation story?
Well, I think the dollar is really been key here for a number of reasons. And this gets back again to how you look at the markets and how you really look at stuff on a data-driven perspective. So that one of the best leading indicators for the dollar is the real yield curve. So there's a huge amount of focus, as I'm sure you're aware, Erik, on the yield curve. And I remember looking at the yield curve back, 5-10 years ago, around the last recession, the GFC recession. It really wasn't the same amount of focus on the nominal yield curve back then, certainly as a recession indicator. But now, every man and his dog talks about the yield curve. And the problem, of course, is that there's such a long variance between the time between when it inverts and when you actually get recession for it to be of much use. What I think is hugely more useful, especially again when we're in an elevated inflation environment, is the real yield curve. So I look at like 2s, 10s real. So I deflate the 2-year by CPI and I just look at 10-year real, versus the break evens. And that has been, since the last 9 to 12 months, has been heavily falling. And that really gave a lead on the decline in the dollar that we saw back in October. So basically we saw the dollar decline from October to July, and then over the last few months, last 2 months, I guess, the dollar has begun to rise again. So that trend is still really intact, that trend in the real yield curve. So I think on a medium-term basis, I think the dollar's primary trend is still going to be lower. And what that does, and what that has already done, is that has supported excess liquidity. So I talked about excess liquidity earlier on. So that's the difference between real money growth and economic growth. But a key part of it is it's in dollar terms. So you look at it for the G10. So you look at the G10 money growth and you put everything in dollars. So when the dollar weakens, that gives a boost to excess liquidity. So that's one of the reasons why excess liquidity began to rise, along with the fall in inflation and the stopping and the falling in money growth. So that then points to excess liquidity remaining supported, perhaps into late this year into early next year, which ceteris paribus should keep risk assets supported. When it comes to gold, gold's kind of been interesting. I think in some sense it could have already fallen a lot more than it would normally, given the sort of rise in real yields that we've had. So I wonder if that's some sort of catch up that we're seeing. But overall, again, in this sort of environment, in an elevated inflation environment, especially an environment where the stock bond correlation is positive, and I was looking at this just the other day there, gold is generally in a very good spot. Gold tends to perform well in these environments. So unfortunately, it has the high volatility attached to it. And as I say, right now, it's selling off and it's feeling some of the heat. But again, it happened in the GFC. It was painful to hold. Right? Sometimes when you need something like gold to perform, it doesn't quite do what you want to do. But if you are a longer term holder, I think it is something that will ultimately do what it's supposed to do, which is not only be an inflation hedge, which is kind of only part of it. I think that's overly simplistic when it comes to gold, but really an insurance just against any financial upheaval. I think ultimately that's what gold, one of the gold's best attributes. So if people can hold on to it over the longer term, I think it will ultimately do what it's supposed to do.
Simon, I couldn't agree with you more, and I think your views on secular inflation are extremely consistent with my own. But our job as investors is to consider the possibility that we might be wrong. So when I think about someone like Alex Gurevich telling our listeners he sees a nearly opposite scenario where he thinks that we're headed toward deeply negative interest rates and, really heavy deflationary recession, if not depression, is what Alex sees on the horizon. Let's imagine that you're a listener who listened to Alex's interview, listened to this interview, really thinks both you and Alex are both smart guys, and the guy wants to design his portfolio so that it's hedged to succeed if either you're right or Alex is right. I don't know how to design that portfolio. Is it possible? Is there a way to get this secular inflation call wrong and still be successful in the market?
I think it's a very good question, and by that I also mean very tricky question because I've thought a huge amount about inflation and whether you're wrong. I think the key thing to say is if you get inflation correct, I think a lot of other things fall into place. In the environment leading up to when inflation began to become elevated, in 2020, 21. We didn't have to really think about inflation, right? It was kind of like it was the so-called nice decades, the non-inflationary continuous expansion. And all, as I mentioned before, kind of rules of thumb that people kind of relied upon, like, stocks and bonds being negatively correlated, financial assets being basically the only game in town, taking on leverage didn't really matter to some extent how much leverage you took on because rates were going to remain low. All these things didn't matter when inflation was kind of low and stable, but now it's not. It really is a huge game changer. So if you get inflation right, you're probably going to get a lot of other things right. But I think it's such a huge bifurcation in terms of the decision tree, whether you get high inflation, or the decision tree whether you get very low inflation. It's difficult to conceive of something that's going to work in both of these extremely different worlds, if not universes. So the usual thing would be, if you are going for, say, an inflation hedge, find something that if you're wrong, obviously you want stuff that's highly convex and things that have very, low negative carry that you can hold on. Now, I've not looked at this recently, but I remember going into this inflation back in 2020 time, one thing I was looking at was paying long-dated pair swaptions. And the beauty of that trade, if you thought it was going to be inflation, rates were super low. The curve, was very kind of flat. Rate volatility was also low. And the cost of putting that position on, because everything was, kind of flat, was tiny. So even if you were wrong, your bleed was minimal. So I would suspect that you're not going to find trades that are, if you like, right in both scenarios. You're going to have to find trades that are extremely, convex and cheap to hold on, even if you're wrong. Given my view, I've looked more closely at inflationary ones, but I'm sure you'll be able to find ones that would also work in a deflationary world. I will say one thing though. I think it's not really factored in and appreciated. I think people are still playing off the old recession playbook, which is you sell stocks and you buy bonds. Really, that's unlikely to work in an elevated inflation backdrop. So obviously, if we get a deflationary thing, yes, bonds will rally quite hard. But even if, I think in a normal recession, we don't get any extreme inflation or deflation, I still think people will rush to buy bonds. But that might be the wrong thing to do, because in an environment where, you have Phillips curves that are nonlinear and unstable, which is what you get when inflation is elevated, you don't have the same relationship with unemployment and inflation that led to bonds being a very good recession hedge. So instead, what happens this time is we get a growth shock that comes with inflation, and you can get stocks and bonds selling off together. So I think there's lots of trades that people are expecting, or investment rules of thumb people are expecting they're going to be as normal, but I just don't think that they are correctly priced in, partly through recency bias, but also partly, I imagine as well, through institutional constraints, because if you can't really hold any financial assets, there's not really much left. There's such a huge part of the investment landscape. Last time I looked, I'm sure it's roughly 90% financial assets and say 10% commodities when it comes to market traded stuff. So you really don't really have anywhere to go. So I don't know where that's going to lead, but I just don't think this market is even remotely prepared for inflation that's going to reaccelerate. and remain for a long time.
Simon, another theme that I've heard from some of our expert guests is that we should be watching for a credit event. People have said if you want to know where the shoe is going to drop on the next big leg down in the bear market, it's going to be after some kind of credit event hits the tape. Is that what you're alluding to on page 5?
Well, I think credit is something that's extremely interesting because it's not really behaving in a way that it has done in normal cycles. So normally, again, if you're very data-driven and you follow leading indicators, one of the best leading indicators over the last 20 years has been credit spreads, especially high-yield credit spreads. But if you look at a number of indicators, it tells me that the credit market is, the credit cycle is deteriorating. So, we've seen banks, for instance, are tightening lending standards. Demand for loans are falling. Charge-off rates for loans are rising. And very interestingly, and I have that chart there, bankruptcies. So you can look at bankruptcy filings. So they tend to lead official Chapter 11 bankruptcies. So Bloomberg amalgamates them. I think they look at companies that have gone into court filing for bankruptcy with liabilities of over $50 million. And normally these bankruptcy filings track credit spreads, high yield credit spreads. And you can see from that chart that lately we just haven't had that. You've had this rise in bankruptcy filings, but credit spreads haven't really reacted to that. And I think there's a number of reasons for this. I think one sort of relationship I'm sure many of your listeners are familiar with is very high correlation between the VIX and high yield spreads, which is the chart on the left-hand side. And that's for a number of reasons. Well, one reason really is just about the capital structure. So really the equity is kind of the sliver of capital between assets and liabilities. So that when you get cash flows become stressed, the equity tends to have to bear the brunt of the stress. So it tends to be very volatile, and high yield is not far above equity in the capital structure. So you tend to see a very similar relationship between the two. But interestingly, there's an even more direct input here. And VIX, low VIX, I think is one of the reasons why credit spreads are preternaturally looking low and not necessarily, or probably not at all, reflective of what's really happening. And that's the so-called Merton distance to default model. And that model basically people use to help model credit spreads. And you assume the equity is a perpetual call option on the solvency of a firm. And then you use Black-Scholes essentially to back out, the volatility of the asset, which is unobservable. But one of the inputs is the VIX or something similar to it. And because the VIX has been very low, and that VIX has been driven low by, I would say, two main reasons. One, is implied correlations have been very low. And the reason for that is most likely due to, the very narrowness of the rally that we've had this year, the AI-driven rally, the so-called Magnificent Seven. And the second thing I would say is probably a large part to do with, option speculation. So I think gamma hedging has repressed volatility as well. And that's probably been exacerbated to some extent by, 0 days to expiry options. So these things have driven, the VIX lower, and I think that's impacted into credit spreads. But I therefore don't think they're a particularly good barometer now of what's actually happening. And I think that's been further obscured by the private credit markets. So the private credit markets now, a huge, $1.5 trillion, things like leveraged loans and NAV loans and things like that. But because it's, essentially off market, I think it's obscuring price discovery. So the normal kind of sequencing that you would get in terms of like loans going bad and then the market being generally aware of that and that being reflected in credit spreads, I think that's been massively delayed and distorted. So really credit spreads are probably not really telling us what's actually happening, under the surface. And that would be another reason why, I mentioned earlier, recessions can happen quite quickly. I think in this cycle, all of a sudden, if we discover credit is significantly worse, or say we get a sudden rise in the VIX and that feeds into credit spreads, all of a sudden things suddenly look very, very bad. And credit spreads themselves are probably one of the kind of the strongest vectors, if you like, between the real economy and between markets. So when credit spreads widen, they're very quick to generate one of these feedback loops. So I think as a risk goes for, say, a recession, which I think is more likely right now to be mild. But if I had to say what a risk factor was that the recession could be more serious than that, that could be credit markets suddenly deteriorating to reflect the true underlying fundamentals.
Let's go a little deeper on your comments about stock-bond correlation, because one of the predictions that we discussed, I want to say a couple of years ago on this show with several different guests, was this idea that there was so much of institutional finance tied up in risk parity trades that a lot of people were predicting, look, if you got a forced unwind of risk parity, where you had a breakdown in stock-bond correlation that started a selling of both assets at once because people were de-levering risk parity portfolios, that could potentially start kind of an avalanche effect where once it gets going, it can't be stopped. It seems like the prediction of the stock bond correlation, switching into positive has already happened, which people were predicting back then. The prediction was if that happened, it could just start this avalanche, which goes totally out of control and nothing can be done to stop it, and the markets crash. Is that still a risk? I don't follow, how much exposure there was on risk parity trades institutionally 2 years ago versus today. Is there still as much risk as there used to be? And what could happen if this stock bond correlation continues to stay positive?
Well, I think the risk, certainly risk parity and all the things you mentioned, is certainly a possibility. But when I last looked, I think risk parity is something like $120 billion strategies under management. That's probably dwarfed by the more traditional 60-40 portfolio construction. I imagine that we're talking here hundreds of billions, if not trillions, are multi-asset portfolios with roughly these sort of ratios. And I think they're all risk parity, and the whole kind of 60-40 construct really starts to come unstuck when you have the stock bond correlation moving positive. And again, this is one of these things I just don't think the market's really caught up yet. Again, either through recency bias or just through, institutional restraints. Not really sure what you're supposed to do other than, pile everything into cash. And obviously that's most likely not feasible for a lot of managers. So now that you've got this positive stock bond correlation, of course, the reason why bonds have been so attractive over the last 15, 20 years to so many investors, and that's what's driven the term premium, or one large part of it. Say quantitative easing has also been part of it. But driven term premium so low is they've been very sought after. They're a portfolio hedge, so they dampen returns, so you get better risk-adjusted returns, but without really impacting the total return compared to equities that much. And they're a recession hedge as well. And I already alluded to the fact that, that only works when you have a linear, sort of normal, stable Phillips curve, and we just don't live in that world anymore. So, this stock bond ratio being positive will lead a lot of people eventually, I think, when they realize it's not an aberration, it's something that's here to stay. And the reason why, by the way, why you tend to get stocks and bonds moving together, and we saw it in the 70s as well, is it's driven by inflation expectations. So inflation essentially just starts to drive everything, and stocks and bonds start to move together. So, I think when people realize that it's not an aberration, it's something that's going to be here for some time, it's obviously people are going to have to start to make decisions of why hold bonds if the two reasons why you originally held them don't really make any sense anymore. And then what do you do?
Simon, let's imagine what you just said happens, which is there's a realization in markets. Maybe somebody famous says something publicly that, hey, look, folks, we've got correlations that are positive between stocks and bonds. It's here to stay. It's a new secular change. And there's a realization that, okay, this hedging function that we're used to for, I don't know how many decades it's been that everybody has used that hedging function, but it suddenly isn't working. Does that potentially have the risk of creating a self-reinforcing, vicious cycle of selling, where selling begets more selling, and you basically have a crash of bond markets as a result of the market realizing, hey, wait, bonds, as you just said, don't serve the function that they used to serve. Maybe we don't need them anymore. If everybody doesn't need them and sells them, boy, who's going to finance the government?
I don't think you get that kind of worst case scenario. Certainly not anywhere in the near future. But I think people will be looking at their portfolios. Like what's the point in holding on to this asset that as I said earlier, it's not doing what it's supposed to do. So then you go, what are your alternatives? So you go, do I look at corporate debt? But the problem there, of course, is the corporate bond markets are kind of dwarfed by the treasury market. So, but you can't have everybody really, try to replace their treasury with corporate bonds. Then you might look at things like commodities or gold. And actually, if you look at them, they actually do improve the risk-adjusted returns in positive correlation environments, stock bond environments. But again, you've got the same problem. I mean, you can't, you're a manager there with hundreds of billions under management. You can't, go into commodities. You can't go into gold, things like that. So they're not really viable. And cash isn't an option either. Cash right now is very attractive at, over 5%. But you can't, you've got rollover risk and you have to justify fees. You can't really just pile your money into 3-month T-bills. You're kind of like a cul-de-sac. And I'm wondering whether people just think, you know what, why don't I just buy more equities? Because I need higher returns. Obviously, it's in a positive stock bond environment, as I mentioned before, you have a higher cash. You tend to have higher cash rates. So you kind of you've got a higher bar to begin with anyway. And so you might conclude, given your constraints in terms of liquidity and in terms of where you are with risk-adjusted returns, and also you're not getting any benefit from owning bonds anymore like you did, you might just decide to up your equity proportion. And that might make sense, again, from an individual sense, but does that really make sense, or is that good for the market as a whole? I mean, I don't think so. You have much higher concentration risk, but if you've got no viable hedge, no real alternative that's really ticking all the boxes, then it might be something that happens. You just have this environment where people are we're back to TINA essentially, but TINA with a vengeance. And people just think there's nothing else they can do apart from buying more equity. So I don't think you get the crash in that way. I don't think it happens overnight, but I do think that the penny will have to eventually drop and people will have to re-examine how their portfolios work. If we're right, that is, of course, that we are in an elevated inflation regime.
Simon, I can't thank you enough for a terrific interview, but before I let you go, please tell our listeners, because they're used to thinking of you as a variant perception guy, you're now Bloomberg's Markets Live macro strategist. What exactly does that mean? I think you write a blog. Where can people find that? And tell us more about how they can follow your work.
Yeah, sure. So the Markets Live, it's not just the blog I write. So we have a whole group of people at Bloomberg around the world. So it's a blog that people write about, very markets focused. And it's 24 hours a day, all through the week. And on top of that, I also have a column that's twice a week called Macroscope. And there I cover, a lot of the same stuff that I will cover in the blog. But it's a very kind of stand back, try and see the wood for the trees, broad kind of macro outlook.
Patrick Ceresna and I will be back, and Nick Galarnik is back from vacation as MacroVoices continues right here at MacroVoices.com.
Erik, at the top of the show, you said you had a big announcement to share with our listeners. What's on your mind?
The release of my Energy Transition Crisis docuseries has taken a bizarre turn that I'd like to share with the MacroVoices community. I began this project intending that the low-budget YouTube version that I just released at EnergyTransitionCrisis.com, that was supposed to be the dry run, and if the message got traction, well, then maybe I'd make a more substantial investment and or solicit co-investors to make a proper broadcast-quality documentary series for the streaming services, which would probably keep me busy for a couple more years. The whole motivation for all of this was wanting to find something that I can do in my retirement to feel that I still have a clear purpose in life, and which I could do while living anywhere from the comfort of my own home and at the relaxed pace of a retirement hobby rather than a high-stress job. Ironically, it was my reaction to my own words in my own docuseries that inspired me in a completely unexpected way. In the first episode, I make the accusation that the politicians and COP conference figureheads are not even engaged in solving this problem of energy transition. They're only engaged in talking about this problem in order to get more votes. Hearing myself say those words woke me up to my own hypocrisy. I'm immensely passionate about this cause. I'm a seasoned, accomplished entrepreneur with a proven track record of knowing how to make things happen and get things done. And I have a crystal clear vision of exactly how a sovereign nation, with the goal of becoming a leader in nuclear energy, could literally leapfrog the rest of the nuclear industry by acquiring the most exciting advanced nuclear startups that are presently unable to get funding because there is no regulatory jurisdiction on the planet ready to deal with their advanced designs. The key to this is that it's what I believe is suppressing valuations of those companies. A sovereign has a massive arbitrage opportunity not available to a private sector investor who can't offer the company being acquired a place to test its reactors as part of the deal. And if I were in charge of calling the shots for one of those countries' sovereign wealth funds, I'd know exactly what to do. I'd roll up all the most promising advanced nuclear startups, let them stay in the countries where they're presently organized, and put all the testing and certification in the sponsoring country. The opportunity for the right sovereign nation to control the advanced nuclear industry is amazing, and I'm spending my time making YouTube videos of me talking about solving this problem. That's the very thing that I criticize the politicians for doing. So I've made two really big life decisions in the last week. Fuck making any more documentaries, and fuck retirement. I'm done talking about how to get energy transition on track, and I'm ready to just do it. Not someday, but right now, while the opportunity is still ripe. The optimal scenario would be for the U.S. government to get its shit together around nuclear energy policy, so that I could do this in the country I was born in. But sadly, I've given up on my own government getting its shit together in the 25 to 30 years I personally have left on this planet. And I'm not ready to die until I solve this problem by building the Toyota of small modular nuclear reactor companies first. What's needed is for a sovereign nation or its sovereign wealth fund to recognize two very important things. Number one is the incredibly ripe opportunity to seize control of the global advanced nuclear industry and fast-track testing and certification of advanced reactors, particularly advanced technology small modular reactors, which will revolutionize the way we think about nuclear energy. So I want a full-time job, working for a sovereign government that's not as screwed up as my own government. I could work for that government or its sovereign wealth fund. The job description I want is simply making that country the undisputed leader in advanced nuclear technology within 10 years. And I'm willing to work for an annual salary of $1 plus a really, really big bonus to be paid in arrears only after I achieve the stated goal and make my new employer the undisputed global leader in advanced nuclear energy. And I'd happily move anywhere in the world for that job. The reason this opportunity is so incredibly ripe right now is that most of the energy transition and climate community is completely clueless on advanced nuclear technology. And even within the nuclear community, few people really understand the merits of liquid-fueled molten salt reactors, which can load follow, making them suitable for both baseload and intermittent supply, and which can operate in the middle of the desert with no adjacent ocean or river to provide cooling water. The COP conference crowd is just wasting time pretending unrealistic solutions are scalable when they're not. They don't have a clear vision for how to really pull this off, and the vast majority of them don't even have a meaningful understanding of the scale of effort that will truly be required. The advanced nuclear startups who are pioneering the most exciting technology that really holds the most potential are all facing the exact same challenge. No nuclear regulator on Earth even understands molten salt reactors, thorium fuel, and the various other technologies explained in Episode 6 of Energy Transition Crisis. That means these companies have nowhere to test their prototypes and obtain initial certification for their reactor designs. Some of these companies are in countries whose regulators are completely inept, and those companies are literally shopping around the globe from country to country, looking for a friendly jurisdiction they can try to persuade to expand their horizons and allow testing and initial certification of their new advanced reactor designs. The nuclear regulators don't know how to regulate anything but water-cooled reactors, and that's exactly what we should be trying to get rid of. The perfect marriage made in heaven is between a sovereign nation with an interest in establishing itself as the global leader in nuclear energy and those advanced nuclear companies that need a place to test their reactors. The deal I'll propose to my prospective sovereign employer is that we're going to buy a substantial or controlling interest in all the most exciting advanced nuclear startups and then fast-track a nuclear testing and certification facility inside the host nation's borders, so that they're able to manage their own regulators to help rather than hinder the certification process. I'm willing to take the personal financial risk of not being paid for my services until I actually deliver on my promise. But my new employer will need to be willing to give me a reasonable budget. $100 billion would be perfect, but I think I could do it with 50 in a pinch. And yes, that's definitely billion with a B, not million with an M. I don't want to run an investment fund to generate alpha for limited partners ever again. Been there, done that, got the t-shirt, not interested. What I do want to run is an acquisition fund, mandated to acquire the companies needed to make the sponsoring nation an undisputed global leader in advanced nuclear within a decade. That's the mandate I'm looking for. I know exactly what needs to be done. I know which companies need to be acquired or controlled through a majority investment stake, and I already have product lines in my head that will evolve from rolling up those companies. The first product will be the Honda Civic of SMRs, a pressurized water design that will easily trump NuScale's not-so-small, not-so-modular approach and be able to compete with NuScale and others for SMR market share early in this game. There are several more products after that, starting with a molten salt, thorium liquid-fueled, load-following SMR, which will become the Toyota Corolla of SMRs and which we'll manufacture at least 50,000 units of in the first decade of production. And by the way, those 50,000 SMRs will replace every single watt of electricity that we get from coal today worldwide. I'm debating whether I want to be the manager of the acquisition fund or the CEO of the roll-up that acquires the best advanced nuclear startups, but either way, I'm quite certain that I know exactly how to establish my next employer as the global leader in advanced nuclear technology. And I'm passionate about being the guy to pull this off. And to be clear, I don't pretend to be an expert on all the nuclear technology itself. It's a subject I've only been studying for less than a year. What I do have is a crystal clear vision as an entrepreneur of exactly what needs to happen, which companies I need to acquire, roll up, and reorganize in order to achieve the vision presented in episodes 7 and 8 of Energy Transition Crisis. And I believe in the power of the podcast. So I'm laying out what's on my mind in hopes that someone in our audience has the ear of someone who knows someone. I'd really love to pitch these ideas in person to anyone willing to listen who's legitimately in a senior enough position in a sovereign government or sovereign wealth fund to make what I'm talking about actually happen. Advanced nuclear is going to save humanity from the coming global energy crisis that will begin in the mid-2020s, and which will continue until we get nuclear back on track. Controlling that industry will assure my new employer of being a global leader in energy for many decades to come. The most obvious candidates are the Arab nations because they have the oil-derived wealth to be able to do what I'm talking about, and they have a very strong incentive to secure their position in the energy industry well beyond the age of oil. But frankly, I'm open to working with any country that's ready to throw out the bureaucratic bullshit that defines most governments in the West and actually make things happen in the here and now. Right now, a grand total of just 436 nuclear reactors are operating in 32 countries worldwide. To achieve energy transition and break our addiction to fossil fuels using SMRs alone, we'd need to build 180,000 Generation 4 SMRs by 2050. All the details of why so many are in my docuseries. And to be clear, I'm not talking about small community reactors, which frankly is a dumb idea in my opinion, despite its immense popularity. We need gigawatt power plants to solve our fossil fuels addiction, not megawatt power plants. The reasons it's better to build a gigawatt power plant using 24 SMRs all sitting in the same building and ganged together, rather than using a single very large reactor such as a Westinghouse AP1000, may not be obvious at first, but they're all explained in Episode 7 of Energy Transition Crisis. It's all about maximizing the use of assembly line manufacturing to achieve economies of scale and quality control that could never be possible in bespoke construction. And it also eliminates the need to build and later demolish the building containing those SMRs under low-level nuclear waste rules. All that's needed is a sovereign nation that's serious about being a global leader in energy well beyond the age of oil to step up to the plate. I know exactly how to make it happen, but I'm going to need a big budget to pull this off. I'll be in Dubai for the next couple of weeks, and I'm looking for media opportunities while I'm in town, because starting today, my full-time job is looking for the full-time job I just described. One of our listeners was kind enough to broker a talk radio interview I'll be doing on Wednesday, October 4th at 7:50 a.m. Dubai time on Dubai Eye Business Breakfast. And I'd love to find other business media opportunities before October 15th, my departure date. I'm done making documentaries. I want to implement the plan I already laid out in episode 7 of the docuseries I just released and solve this problem for humanity once and for all. It will keep me busy for the rest of my life, and I look forward to the challenge. I already got retirement out of the way when I screwed off on a yacht for a few years after selling my software company in '98. I'm ready to go back to work, and I'm ready to get this done. I know exactly how to create the advanced nuclear SMR company that will truly solve energy transition, and I'm ready to do this as soon as I can find a partner nation with leadership that's ready to actually get this done. And no, I won't be staying in Dubai for the COP conference in November. I'm interested in actually solving this problem. COP is for people who just want to virtue signal that they're talking about solving this problem, and that's not my cup of tea. Thanks for listening to my sales pitch, folks. And if anyone listening has the ear of anyone senior enough in any sovereign government or sovereign wealth fund to be able to negotiate the size deal I'm talking about, I would very much appreciate an introduction. You can email me via info@macrovoices.com. Nick Galarnik is back from vacation, and Patrick, Nick, and I will be back with our postgame segment right after this message. Energy Transition Crisis, my new video documentary series about energy transition, has finally been released, and anyone can watch it for free at energytransitioncrisis.org. The series explains exactly what it's really going to take to break humanity's addiction to fossil fuels and why it will take longer and cost more than almost anyone realizes. And I'd like to think the 3 episodes on nuclear energy are among the most detailed on YouTube. This is a passion project for me, and there's no profit motive, no revenue, and therefore no budget other than donations. I'd really appreciate your help promoting the series. Things you can do to help include subscribing to the Energy Crisis Doc YouTube channel, liking every episode, posting comments on YouTube, and posting links to your favorite episodes on social media. If you don't have time to do those things, there's also a donations page at energytransitioncrisis.org. The money does not go to me. 100% of it will be spent on YouTube and other social media advertising to promote the series. Thanks in advance for your help. Now let's get back to the show and Patrick's postgame chart deck.
Now, back to your hosts, Erik Townsend and Patrick Ceresna.
Erik, it was great to have Simon White back on the show. Now joining us in the post-game segment is Nick Galarnik. Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Simon's picture that says looking for the downloads. Now, Erik, let's start off by covering crude oil, starting with the EIA inventory data.
EIA printed a drawdown of 2.2 million barrels of crude oil nationally, and that's in addition to another 0.3 million barrels that was drawn down out of the Strategic Petroleum Reserve. Now, I know what you're thinking. Wait a minute, that must be backwards because the Biden administration promised us they'd be refilling the Strategic Petroleum Reserve right about now. I think what it is in Bidenomics, what they're doing is they're refilling it every week. They just happen to refill it with a negative number this week. That's all. Nothing to see here, folks. Keep moving. Cushing, Oklahoma, drawing down 943,000 barrels. Not quite a million barrels. Doesn't sound like that big of a drawdown, but on a percentage basis of what's left in those tanks in Cushing, it's absolutely monumental. Cushing cannot last much longer with all of these big drawdowns, and that's the reason that we're seeing this explosion in the WTI time spreads. And finished products were the builds on the board, with gasoline building 1 million barrels and distillates building 398,000 barrels. U.S. production held steady at 12.9 million barrels. Yet another example this week of an overbought market dipping far less than expected and then powering higher much sooner than expected. The term structure is absolutely exploding upwards. This is the biggest move since February of 2022 when the Ukraine invasion began. That probably begets the question, okay, does that mean that the market is signaling that there's, some new war escalation coming? No, it doesn't mean that. What it means is that the market is scared to death that there's a possibility it might not be able to settle the November or December WTI crude oil futures contracts. The reason for that is because the inventory has been drawn down to such ridiculously low levels. So it's because of that extremely low inventory level in Cushing and elsewhere that I think this is happening. The market could be smelling out geopolitical risk as well, but one way or another, we're seeing a blowout in the term structure that is usually a very bullish sign for the flat price. We have to be careful to say that here because we're already pretty seriously overbought on the flat price, really right at the top of the channel that the market has been tracing, and a lot of people are saying that channel is just frightfully steep already, thinking it might break down to the downside, but it almost seems to be breaking to the upside. So what's driving this? How much farther does it have to go? We'll find out, but this market couldn't look a whole lot stronger. Big question is just looking this overbought. Surely there must be a pullback coming, right? Well, how many times have I said that in the last 3 weeks?
So on page 2, I have that crude oil chart. And when I overlay this 50-day moving average on there, you can just see how clean of a breakout this entire last 2 months or month and a half has been for crude oil. We've been now in almost a 1-year bear market in crude where it decisively remained in a primary downtrend. And we have now cleared the highs from October and November of last year and really started to see the pattern of higher highs, higher lows, staying above the moving averages. Crude oil is really going. Now, to me, there's 2 really important hurdles for crude oil, and they're the fib zones that lie more or less in this $94 area and this $100 area above. The 100 is also obviously a key psychological factor. You're going to certainly get a huge number of headlines amongst all the major financial media outlets when the $100 level is hit on crude. I think both of them are reasonable targets here as the momentum in crude simply has not given out. The bigger question in my mind is that really bull scenario, that one where Goldman Sachs just came out with a $150 target. Are we seeing this begin a substantial new primary trend that will last the remainder of the year and keep or even head right back to the 2022 highs? I'm a little bit cautious of making that bold of a call here. Right now, I think this approaching the upper targets toward 100 is a very realistic short-term target. And then I want to really see how the price action settles in. And if it looks really good, I think looking for continuation patterns will make a whole lot of sense. Now, let's move on to equities. And this is, Nick, where I want to get you involved. It's been a while since we got an update from you. So let's talk the S&P 500. What levels are you watching?
Spot price right now is approximately 42.80 on SPX. We have a call wall above at 43.50 and a put wall far below at 4,200. The implied move for the October 20th monthly OPEX is plus minus 140 points. So the expected move to the upside would be 44.20. And the move to the downside would be 41.40 approximately. Now we have key resistance just above at 4,300, key support just below at 42.50, which was tested yesterday, and then support just below that at 4,200. Given that we're down about 8% from the year highs, I'm inclined to think we see some more pain ahead, possibly some dead cat bounces toward that 43.50 area, but I am not so bullish right now. I'm pretty bearish, and I may be late to the party perhaps, but I do think we're going to see some more downside. I don't see an impetus to hold equities right now, given the risk-free rate. What are your thoughts?
Well, you know what? I agree with you in the sense that I think the highs of the year are likely in, obviously with only 1 quarter left, it would take a lot of bullish conditions for us to be clearing those 4,600, 4,700 highs that were put in the summer. But the bigger question is if and when are we going to see bigger downside? I think what's going to be really interesting is we have that JP Morgan whale with that collar rolling off at the end of this week. And right now, that 4,200 strike where a lot of the open interest is on there was been acting like a bit of a magnet. The bigger question for me is, will that cause the reflexive rally? And while you were talking 43.50, I think we can easily have 100 to 150 point rally that basically is just unwinding this incredibly short-term oversold market. But like you were suggesting, I think all rallies will be easy to fade. I think that at this point, short-term rallies should be sold, and I think that's going to be the trend moving forward. Nonetheless, Nick, let's talk the Nasdaq. Obviously, the relative strength of the Mag 7 have held this up better than other charts. What's your thoughts, and what are the levels you're watching?
Spot price right now on Qs is about 356. We We have a call wall above at 370 and a put wall just below at 350. Key resistance above is at 370 and then 380, and then key support just below at 350. The implied move for the October 20th OPEX is plus minus 16 points, which puts our upper expected move at 372 and our lower expected move at 340. Again, I'm pretty bearish right now because I'm looking at names like Amazon and Microsoft, which are breaking down to new lows. Microsoft right now is below its 3-month low. Amazon is testing lows, recent lows. And then you have Apple as well, which is breaking to new lows as well. So seeing the big names fade down doesn't give me much confidence in broad markets, because right now 7 names account for about 50% of the gains we've seen in the markets over the past year, whereas the remaining 493 in the S&P have accounted for about 5%. So without those big names rising up, it's hard to see a push upward. And again, you said previously that you see a rally perhaps, and I do see that we may have some of these dead cat bounce pops where we pop 100, 150 points over the course of a few days. That's indicative of what happens during a higher volatility market.
Well, speaking of volatility, I think that's exactly what we need to talk about. Earlier, Simon White was talking about dispersion in returns as being a contributor to keeping vol conditions pretty low. I suspect another contribution to that has to be a lot of the short gamma overwriting that's occurring by a lot of participants who see only limited upside potential, keeping an ample supply of that short gamma up there. And the thing is that I think has suppressed volatility. To me, I find it really surprising that we're at these levels, because the last time we had a 300 plus point drop was during February-March sell-off, where obviously regional banks were under a lot of stress. I mean, we were seeing the VIX approaching 30 on the upper end. Here, I'm surprised that we have not seen the aggressive selling spur the animal spirits that are driving high volatility premiums. And it'll be really interesting to see, can we see a short-term swing bottom occur without a VIX printing above the 20 handle? To me, I'm seeing this as a strange divergence in the market, but I'll tell you, in order for us to see the end of this swing trade sell cycle, even if there'll be dead cat bounces, I think we need a little bit of more of a spike in vol premiums as there's going to be a little bit more panic. I mean, the unwind of these vol targeting funds and other types of products, including right now, is where a lot of trend following methodologies will start to flip short on the downside of the market. And this is the kind of selling that spurs on margin calls. And so I think that you're bang on. We're going to see definitely failed rallies, but I think there's more to come. But what do you make of this VIX?
So right now with the VIX at around 18 or so, we expect about 1.2% moves in broad markets each day. And what I'm looking at is that, I'm thinking about this in a broad sense, in that larger equity holders are not trying to offload their equities in one fell swoop so as to fire sale stock prices. And by doing so in a gradual manner, that suppresses volatility. Additionally, if people don't plan, and I mean, I want to say people, I mean market participants, if participants don't plan on holding equities longer term, the demand for hedges in the form of puts is also suppressed. So that can kind of keep volatility dampened as we decline in a gradual fashion. Like yesterday, for example, we're down about 1% at the lows, yet the VIX wasn't spiking too heavily, which is very, very surprising, right? But I do think that this lack of demand for equities going forward over the next perhaps 6 months or so would suppress the demand also for insurance in the form of puts, which will also suppress the VIX perhaps. Now, moving on to page 7, we have the US dollar index. What are you guys thinking here?
Well, guys, I'm getting concerned. Brent Johnson's scenario of a retest of 115 on the Dixie is looking more and more realistic every day. And as I look at this chart, it doesn't seem to me like there's any technical reason to doubt that possibility. And using just a very simplistic measured move analysis, it looks to me like a break above 115 should take the Dixie to 122 or so. Now, I don't profess to be expert enough to know the full details, but what I will say with strongest conviction is if the Dixie hits 122, a whole lot of other shit is going to break, starting with EM debt. And EM debt would just be the first domino to fall. I'm not making any prediction that the Dixie is going to get to 120. I really thought 115 was going to be it. But what I do predict is that if the Dixie moves over 120 and stays there, the longer it stays at those levels, the more EM defaults will develop contagion to other markets, and it won't be pretty.
Yeah, Eric, clearly this is a bull breakout. The bigger question in my mind is how much does it accelerate? How much does it gain traction? I mean, those previous highs on the US dollar yen near 150, 152 are certainly going to be an obstacle. But if we see, the US dollar clear those levels, at the same time, a euro that's breaking below this like 105 level, heading down towards parity, like if we see these types of feedback mechanisms get going, that could really accelerate the dollar, which would create its own feedback mechanism. And that could certainly be a contributor to sending this risk-off message throughout the entire marketplace. To me, this is a very clear new bull trend in the dollar. We've clearly beat a lot of important hurdles. And to me, what will be the real test is going to see how traders behave during a short-term pullback. Like, let's say we have a quick drop on the dollar index towards 50-day moving average near 104. Will it be aggressively bought on dip? Will we see it work its way quickly right back to the previous highs? We're going to be watching that price action to really see whether or not this continues. But right now, it's very hard to take any position other than looking on for a little bit more strength in the dollar in the short-term period to come.
Now on page 8, we have the gold futures chart. Eric, what are your thoughts here?
Well, obviously, it's a bloodbath over the last few days, but this should come as no surprise to MacroVoices listeners. As we've been telling you for the last several weeks, there's good reason to think that rates will stay higher for longer and that the dollar might continue to strengthen as it has. We told you if that happened, gold would be in trouble. And if it broke its 200-day moving average to the downside, you could see a big acceleration as everyone panics at the same time. Well, that's exactly what's happened in the last few sessions. The good news is that if you do a comparison to the Dixie, the last time the Dixie was this high, the spot price of gold was much lower. And even using the contract chart, using the December contract chart rather than the continuation chart, Wednesday's price is still just barely above the March lows, when the Dixie peaked at a lower level than it closed on Wednesday. So the point is, despite the selling, gold has been more resilient than one might expect on a correlation basis. I remain steadfastly convinced that the trade of a lifetime is to go long gold with leverage the day before the Fed really and truly does reverse course and pivot dovishly. I still think that's quite a few months off, so I'm not expecting any new all-time highs this year. But I do expect that the bottom of this correction could come this year, and I hope I'm lucky enough to lever up there. When the Fed ultimately is forced to cut rates, gold is going to soar. But I don't think that's a 2023 story. I think it's next year.
Eric, I don't make this much more complicated. To me, I look at gold as a cross currency to the US dollar, and I understand real yields and other things like this, obviously contributors to the trends. But to me, in a period where the US dollar strength is prevalent, then it's going to be a drag on gold prices. And that's what we're witnessing here. And at this moment, with this breakdown, while there's some short-term support lines in the next 50 or so dollars lower that could create a bounce or a reaction, I think that generally the time for gold to shine is going to be a little bit later in the year or even in the first quarter, once the market starts getting a hint that maybe an easing cycle might be actually sooner than everyone expects. But right now on the short term, with the dollar doing what it is, it's a lot more of the same. I don't think there's going to be a huge downside. I don't think that gold's going down to 1,600, but there's certainly no indication that a new bull trend or an accumulation cycle has begun. And so temporarily, you're going to have to stay underweight and hedged gold until the next buy signal gets underway. Nonetheless, Nick, I wanted to wrap up here with looking at three charts. I wanted to look at the copper chart on page 9. And what we continue to see is copper remains structurally weak. Lower highs, lower lows, working its way down. This is in line with generally global economy that is contracting and relatively weak. And while I remain big picture very bullish copper, on the very short term, this is a chart that typically would break down. And seeing copper go to 350 and even retesting the October of last year lows near 3.25 are entirely possible, especially if we see all broad assets in some sort of a risk-off cycle. But on page 10 is the single most bullish area of the market right now, which is uranium. And the U308 north of 70 on the upside. They're all clearing multi-year highs. And more importantly, this is almost becoming a parabolic rise on the upside. Now, I tend not to want to encourage people to be buying rips. I prefer buying dips. But this is a very hot market. And what I think is that when it does dip, it will probably be very short and fast. And it'll be really interesting to see how fast the bulls come right back in there and buy that dip. So uranium's just staying super bullish. Now, the final chart I wanted to look at was that 10-year US Treasury yield. And while I was trying to be optimistic that the previous year highs were going to hold, it is clear that the bond market has some more selling to do. It's amazing that we're at 460 in this type of an environment. While will we see 5%? I mean, there's a chance that we can get to 470, 480, and this trend continues for several weeks. But my gut feeling is that we may not make it all the way to the 5% level. But clearly, that's speculation at this moment. I'm watching this closely to see where this peters out and where a potential bond bottom may start to form.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
Well, in this week's Research Roundup, you're going to find the transcript for today's interview, as well as Simon White's slide deck and the chart book we just discussed here in the postgame, and a number of links to articles that we found really interesting. So you're going to find this and so much more in this week's Research Roundup.
Well, that does it for this week's episode. We appreciate all the feedback and support we get from our listeners and are always looking for suggestions on how we can make this program even better. For those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account @MacroVoices for all the most recent updates and releases. You can also follow Erik on Twitter @Erik S. Townsend. That is Erik spelled with a K. And follow Patrick @Patrick Ceresna. On behalf of Erik Townsend, Patrick Ceresna, and myself, thanks for listening, and see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Erik Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.